I kept the receipts. Welcome to this first episode in December of the Capital Stewards podcast, one that I hope will become kind of an annual thing that we do. We'll have a little bit of fun and talk about markets, where they've been so far this year. We're going to look back at a few forecasts that were made at the end of last year, 2023, and see how they turned out. We'll also look at our own views that we shared in our 2024 Outlook piece at the end of last year. The point of this exercise, by the way, is not to poke fun at the various Wall Street shops or to puff up or degrade our own projections. It's to demonstrate how difficult it is to project, especially over the short term, where investment markets are going to go. Understanding how difficult it is to predict where the market's going to go, and perhaps a little bit of humility, has significant implications for how investors should build portfolios. So we'll talk at the end about how you should invest in light of how challenging it is to be right about the future all the time. So if you're watching the video version of this, we'll put some of the best predictions or maybe some of the most inaccurate predictions up on the slides as we go through this conversation. If you're just listening, I'll talk you through it. So let's dive in. So let's start with the economy. Overall, I think economic forecasting is perhaps better than the stock market, or better than forecasting just the stock market or the bond market. The economy is a little bit like an oil tanker. It's hard to turn in one way or the other, and you can usually see the data change before it starts moving significantly in a new direction, kind of like the wake of a boat. So for this year, the overall macro environment has been relatively strong, right? Real GDP, which is the broadest measure of economic growth that we use, that was 2.8% in the third quarter. As of this week, the Atlanta Fed's now projecting real GDP is going to be 3.2% in the fourth quarter. So it's nowhere near recession territory. We've seen really above trend growth so far in 2024. Inflation has fallen from 3% in January of this year to 2.6% in October. So what were expectations coming into the year? Goldman Sachs expected no recession and inflation to fall back to 2 to 2.5% by year end. That seems to be spot on. JP Morgan expected 2% GDP growth, no recession, 2% inflation by year end, and 4% unemployment, something they call the 2024 outlook. You can see that on the page. That's also pretty close. Perhaps they undershot in growth a little bit, but overall pretty accurate to what we saw in the economy this year. My own thesis on the economy was that the consumer would slow down this year as the sugar high from the COVID era sort of government spending binge that we had wore off. But because earnings have increased in line with inflation, we didn't really see the consumer suffering or a recession this year. We expected payroll numbers to dip in the 150,000 range with unemployment remaining low. I expected inflation to continue moving lower, but with some bumps along the way throughout the year. The last mile of inflation will take a long time. We could get to 2% by the end of the year, but it looks like we're generally going to be in the ballpark with some of our unemployment thoughts. We're going to be certainly sub 200,000, probably running around 150,000 of unemployment. Inflation is going to be closer to 2% than 3, but not all the way back down to 2. So it looks like we were close, but not perfect as well. I didn't expect growth to be quite as strong as what we've seen, and certainly I expected inflation to be a little bit lower than where we are today. So economic forecasting seems fairly straightforward, right? It's not that, well, I won't say it's not difficult, but it seems fairly straightforward for folks to have the right thesis on where the economy is going. What about the stock market and expectations around other asset classes? So that's where this exercise gets a little bit more fun. As you know, many of the shops put out annual forecasts for where they think the S&P 500 is going to end, the next year and perhaps the year after next. So let's talk about the stock market. The S&P 500 is currently trading about 5,900. That's up 3% or so year to date. We don't make S&P 500 level calls every year precisely because it's very hard to do and it's not super useful from an investment perspective. But let's look at a few of those that do. Goldman Sachs expected the S&P to end this year at 4,700, essentially flat performance from the end of last year. Well, the S&P never touched 4,700 in 2024, so that was off by 23% so far this year. BlackRock was underweight U.S. equities going into the year. That wouldn't have worked out very well. They also argued for greater dispersion in returns, which means that the winners separate from the losers and active management outperforms. Well, tech led the way on sort of AI growth this year. The indexes look like they're going to again outperform active managers. Bridgewater, which is the largest U.S. hedge fund manager, expected a grind down in economic growth and sort of lagging strength in the labor market, kind of similar maybe to our forecast. Their view is that the current discounting did not reflect the risks facing the U.S. equity market earnings and margins. You can read all of that as economic speak and academic speak for the stock market should be lower at the end of 2024 than it was at the beginning. Obviously, that didn't happen. Morgan Stanley thought 2024 may be all about threading the needle and looking for small openings in markets that can generate positive returns. They expected this year to be a tale of two halves, with kind of a cautious first half giving way to the stronger performance in the second half of the year. Well, if anything, it's been the opposite. The S&P 500 was up almost 15% in the first half. And if anything, the second half has been relatively weaker, but the market's still up another 8% or so for the second half. So that's a really good performance for any half of a year. Bank of America Merrill Lynch was probably the closest of the group. They expected the S&P 500 to finish 2024 at 5,000, up 10% for the year. They saw mostly a Goldilocks economy with decelerating inflation, higher corporate margins, and a consumer that was slowing but not falling. B of A also favored sort of the U.S. over the rest of the world. That was a good call. Their only real flaw was being underweight technology, which outperformed significantly throughout the year. So even though they were close, they were still off the mark of the S&P 500 by 13% for the year. So my view is probably close to that of Merrill Lynch. I made the case for the stock market returns being sort of in line with long-term averages, so 7 to 9% on our outlook last year. So I also undershot by quite a bit. It turns out, even with lots of economists and lots of PhDs and quant jockeys and the like, it's very difficult to forecast what the stock market will do, especially over a short period of time. What about bonds, though? Is it any easier to forecast other asset classes or the rates market? PIMCO, the Pacific Investment Management Company, some of you may be familiar with Bill Gross, used to run PIMCO. PIMCO is the world's largest bond manager. Their outlook for 2024 said that medium-term U.S. duration is particularly appealing, and in the credit space, we favor resilience. We remain cautious on corporate credit. We're underweight lower quality floating rate corporate credit, such as bank loans and certain private assets. Well, so far this year, shorter term bonds have outperformed, depending on when you bought your assets, and lower quality credit, i.e. sort of junk bonds and bank loans, have significantly outperformed the market. So PIMCO was wrong kind of on most fronts. AllianceBernstein expected bonds to roar back. I always think it's great when people use headlines like that because you almost know they're going to be wrong. They view the 10-year as attractive at 3.9%. But currently, the 10-year sits about 4.1 to 4.2%. The 10-year's gone up. Rates are now in the low fours, and bonds, they certainly have not roared back this year. For the most part, bonds have posted low single-digit returns. So it actually hasn't been a bad year for the bond market. And depending on the kind of portfolio that you have in the bond market, you probably outperform cash. But certainly, we haven't seen anything close to a sort of a roar coming back. Cambridge Associates is one of the largest consultants for endowments and pension funds in the world, and they thought U.S. long-term treasuries would outperform cash in 2024. That hasn't been the case. BlackRock was right to prefer shorter-term bonds, but they were wrong to underweight credit and high yield. And Goldman Sachs, again, for their part, they were closer on the bond call. They preferred credit and higher yield bonds, which is really what worked in 2024 in the fixed income space. My own view coming into this year was that longer term bonds represented an opportunity with yields in the high fours, especially with corporate bonds, credit, and higher yield bonds. Higher yield bonds worked out really, really well this year. And treasuries really so far have just kind of collected their coupon payment, which again, it's fixed income. It's not a bad year. So it's tough to predict bond markets as well as it is to predict the stock market. So after we look at the evidence from predictions this year and the inability for anyone really to predict exactly where markets are going consistently over short periods of time, what does that mean for us as investors? So should we just ignore all these outlook pieces? I mean, why did these big research teams spend all this time and money trying to understand the market and putting these predictions out if they're probably going to be wrong? And the answer is really, I think, two-part. First, forming a point of view and trying to predict the future for any market or asset class and investing based on your perspective is a challenging way to generate long-term returns. Occasionally, you're going to be right. Often, you're probably going to be wrong. And as you can see, sort of all the king's horses and all the king's men from a lot of the big research shops, they struggle to accurately forecast where the stock market and where these different asset classes or the economy are going to go in any single year. My view is that a better approach is to build a portfolio that you can stick with over the long term that has a mix of assets that do well in different types of markets. In most years, your stock portfolio is going to drive returns as the economy grows and companies do well. But in some years, you might need bonds or precious metals or gold or commodities or other assets to provide returns when stocks inevitably go through a downturn, and those downturns are difficult to predict. As you can see from the predictions from last year, it's hard to know exactly when that will happen. A lot of people thought this year returns might be sort of weak, and it turned out that they were pretty strong. So if you just took that view and went into the year, you would have significantly underperformed the market. And so it's really important to build an all-weather efficient portfolio. And stick with it over time and not try to get caught up in trying to sort of move and change your portfolio based on what you think is going to happen in any given year. How do you know if your portfolio is well constructed? First, you should be achieving your desired rates of return in most years, and you should be on track to accomplish your goals. I think that's sort of fairly straightforward, but investing is goal oriented, right? Investing is about setting a goal and then building a portfolio that gives us a high degree of likelihood that we're going to achieve our goal. That's the point of investing. So if you're on track to achieve your goals, you're probably doing pretty well. Second, you should have assets in your portfolio that move in opposite directions. This is where things are challenging, right? Because a lot of times you see something like the stock market going up a lot and then bonds may be going down and people are going, why do we own this stuff that's not going up, right? If everything is going up, that's a problem. And the reason it's a problem is because inevitably a downturn is going to come, something's going to happen, and things aren't going to turn out like you predicted, right? Like a lot of folks for 2024. And when that happens, if everything is going up, then everything will go down. And you don't want that to happen. You want some balance even in strong markets. So what about the outlooks? I do think the outlooks have value. They might help you better understand the risk and return trade-offs that you're making as an investor. What might happen if someone's perceived vision of the future actually unfolds? What might happen if another vision of the future unfolds? Can you live with the different outcomes in different versions of events? And that's where good portfolio construction and the right mix of assets is so important. You should be confident that your portfolio will stand the test of time, no matter which particular vision of the future actually sort of occurs over, the next 1, 3, 5 years, something like that, right? You should be able to stick with your portfolio in good years and bad years. And that will help prevent you from making what, in my view, is the worst investment mistake that you can make, which is to buy high, chase returns, and then ultimately sell low. And when you do that often enough, you just destroy capital along the way. So if you have a portfolio that is well constructed, you should be generating good returns regardless of the environment. And then that should enable you to be successful. And then you don't have to worry about trying to chase returns, or should you sell, or should you buy, or what's going to happen in any given sort of 12-month period of time. So I think understanding different perspectives on where the economy and the market might be headed is an important thing to do. But if you go all in on one view or another, you just need to be wary that you might not be right, and you need to be comfortable with the risk that if you're wrong, you're going to lose money as a result of that. So it really comes down to being diversified and choosing a portfolio that you can stick with all the time, not trying to predict the market year in and year out, because as we see from the outlooks for last year, for this year, it's difficult to predict the market all the time. So thanks for listening to this episode of the podcast. Next time, of course, we'll have our own outlook for 2025. So you can take that with a grain of salt if you listen to this episode. So look for that to drop into your feed soon later this month. I look forward to talking to you down the road.